Good afternoon, everyone. We do have a few more people registered, so I just want to give them another couple minutes. But we, as mentioned a bit earlier, will get started closer to 5 past. Oh, apologies. All right. Perfect. I think I'm going to just go ahead and just do the introductions and just to state what we are obviously going to be talking about today. So a very warm welcome to everyone to this webinar. We're doing these monthly with the AWM group, the Ascot Wealth Management Group, as you can see on the screen in front of you. So it's my turn this month, and we're going to talk about the tax year end, and to a less extent, just introducing the tapered annual allowance. So a little bit about myself. My name is Greg Armstrong, as you can see on the screen, a global wealth manager with the AWM group, and I'll be able to just take you through what the tax year end means and what it actually means for you, which if there's one thing that we'll need to obviously take away from today, is just the urgency of where we are on the 8th of March with the tax year end coming up, or fast approaching, on the 5th of April. Great, so we're going to just take a look at the structure. Yeah, as mentioned, when is the end of the tax year? What allowances do you have available to you, and what are the benefits of utilizing these allowances? I'll say this quite a few times throughout the webinar. With these allowances, in many cases, if you don't use it, you lose it. So something to just keep in mind as I'm sort of talking so far. Great. So when is the end of the tax year? I mean, this is a potentially an easy one. It is the 5th of April. It's Monday, the 5th of April, 2021. So there are effectively 15 business days to the end of the tax year. And I put over there, you actually have less time. The reason being is that providers actually have their own restrictions as to when you can make your investments, for instance, into an ISA investment. they actually have certain restrictions on when you can actually make that investment, so it can be captured with your various providers by the 5th of April. So, as I said, and I will keep saying, there is some urgency attached to tax year-end planning, but essentially, when it comes time to tax planning, we need to be moving away from the sort of mad rush towards the end of the tax year and actually adopt a all year round tax planning strategy. The benefits of that is making regular contributions, for instance, would be pound cost averaging, which would smooth out market volatility, and that's obviously going to be key, because what we don't want, and as we saw at the beginning of last year, when major market events and you're getting all this planning in before the end of the tax year, and the FTSE might be dropping by 5% in a day. So what we do really recommend and promote is a all year round tax planning strategy, and which will obviously alleviate the stresses of the final sort of mad dash to the 5th of April at the end of the tax year. So, as I said, urgency is key at this point in time, but obviously very happy to have a discussion privately about getting a very sustainable tax planning strategy for the year ahead. I do mention there that we do have a tax return service. So if you are looking for assistance with self-assessments and various tax planning strategies, then we can have a discussion there as well. Great. Many of you would have seen the most recent budget. So the spring budget. So what we do have is a very comprehensive update that we sent out, and I'll just refer you to our social media channels where we've summarized the changes and essentially the decisions that were made. High level overview: many of the allowances and tax bands have been kept in place and frozen, with the personal allowance being one of them to have actually just increased by inflation, which is going to be a small amount. Also, one other thing is the stamp duty holiday has been extended. So these are all aspects that for your planning strategies moving ahead post-pandemic will be a key thing to watch these budget updates and the fallout, or the sorry, not the fallout, but basically what comes from these periodic budgets that they put out. So it's not always going to be set in stone that these allowances will still be available, and that just is dependent on these budgets. So I will refer you to the socials for that. Great, so we're going to get started in terms of talking about the allowances that you have available to you. The first one is your personal allowance. This is just setting the amounts of income that you can receive that will be free of any tax and paid out to you. No income tax would be payable on that. The reason why I put that in there is that if you are perhaps currently retired and your pension incomes are below the personal allowance, and you are able to draw some funds, you are able to draw some additional funds, it might be within your sort of best interest to maximize your personal allowance, because you are going to be receiving that income tax-free. What I will also say is that if you have any questions, you can pop them on the chat. Alternatively, we are going to discuss some questions at the end of the webinar as well, if you do have any questions. Awesome. Great. Great. The next allowances to discuss is the individual savings accounts, the ISAs. Now, as you can see on screen, we have adult ISAs at £20,000, junior ISAs at £9,000. So my colleague Jack last month led a webinar on this, which was quite extensive. So we will be able to refer to that post this webinar if you are interested. But yeah, essentially, the benefits of an ISA and a junior ISA is that there is completely, it's in a tax-free growth and income tax-free environment. So there are no capital gains tax to be settled on any growth within the funds. And as I mentioned, you can withdraw it completely free of tax, income tax. I also mentioned here flexible ISAs. So flexible ISAs, this is very important that you are just double checking with the provider or the institution that you hold your ISAs with, that they are flexible or not. Flexible ISAs basically mean if you have £10,000 in your ISA, you'd be able to essentially withdraw that £10,000, but you won't lose that allowance. You'll be able to replenish that allowance and take advantage of your allowance for that tax year. So you'd be able to contribute £30,000 as you haven't lost that allowance that you've withdrawn. Looking at your ISAs, so adult ISAs, there are quite a few that you'd be able to invest in, but the key thing here is that you've got £20,000. That is the upper limit. So you can't have, for instance, £20,000, or you can't invest £20,000 into a cash ISA and £20,000 into a stocks and shares ISA. It is completely limited to £20,000 across all your ISA investments in the tax year. Okay, another factor here, just speaking budget a little bit earlier, is that this allowance has remained unchanged, and it will be frozen until the year 2026. And yeah, just in terms of these allowances in comparison to, for instance, the United States, these are seen to be quite generous. The equivalent over in the United States would allow you to invest roughly about $6,000 US into a completely tax-free environment, that an ISA would afford you. So these allowances are available to you, and as I mentioned earlier, when it comes to budget updates, these allowances are subject to legislative change. So that is something to take a note of for sure. What I also wanted to say is there's a sort of fun, quirky little fact here, is that when you're looking at an adult ISA and a junior ISA, your 16-year-old son or daughter, for instance, would actually be afforded both of them. So what you could actually end up doing is your 16-year-old son or daughter could have a £20,000 cash ISA and a £9,000 junior ISA for the years age 16 up to his or her 18th birthday. So that's just short on £60,000 that could be completely put into a tax-free environment. Obviously, your son or daughter will have control over those funds when it ticks over into an adult ISA, but it is just an interesting little factoid there. Great. So that is the ISA allowances. The next allowance that we're going to discuss is obviously the pensions. Now, pensions can be quite a murky sort of quagmire. Many pensions have terms and conditions that are just make them quite difficult to understand and get your head around. But essentially, just to sort of high-level overview here, your allowances are capped at £40,000. So the tapering of the annual allowance is introduced when you are earning over £240,000, which it will then start to taper down to that £4,000. I mean, if you are earning over if you are earning over £240,000 at this point in time, then it will be a very urgent discussion that you will need to have, because you will need to just double check with your employer if you are going to be over contributing, which would just increase the tax bill at the end of the day. Non-taxpayers are able to contribute up to $3,600. So that is a planning tool that is definitely an important one to take note of. And that's 3,600 is 80% of that is up for your own contribution, and then the government will gross that up to that £3,600. So non-taxpayers, we would definitely recommend taking a look into that that investment or setting that aside for yourselves. Last little thing here is that you can carry forward any unused allowance from the last 3 years. So if there is space in your unused allowances over the last 3 years, then you are able to make use and carry forward that allowance, so you can essentially over contribute in this tax year, which you perhaps could change employments, and your pension inputs may increase or decrease. So it's important that if you are receiving an annual bonus, for instance, that we take a look at the amount that you are able to perhaps carry forward. Benefits, as you can see there, 25% tax-free lump sum. You'll be able to access that immediately as you start drawing down the pension, or as and when you need them. And as with the ISAs, this is also in a tax-privileged environment, meaning that any fund growth or investment growth within the fund is free of capital gains and income tax while it is in the fund. So it's in that tax-privileged environment. The last thing here, as you can see on screen here, it does fall outside of your estate for inheritance tax purposes, and that's an important thing to note. Obviously, with your null rate bands increasing, but potentially will be frozen for the foreseeable future, and obviously with your main residence falling in line with your estate in your null rate band. So it is a very good thing that these pension assets fall outside of your estate for inheritance tax purposes, because inheritance tax is at 40%, which is a sizable chunk that needs to be paid at the point of your untimely passing. Great. Just a quick little tax year in planning example. So for annual allowance planning, so that's looking at your pensions. Why are the following points important to take note of? So that's your pension input amounts. We need to know how much you have put into your pension. That might involve us needing to contact your pension provider or your employer just to see how much you are contributing, so that we know how much space you have in this tax year. We'd also, you'll see at the bottom there, we'd also need that information so we can see if there are any unused allowances to carry forward, which is going to be an important. My apologies. So just losing my train of thought here. Yeah, so it's important that we find out this information and we are able to put that aside, so we'll be able to obviously provide advice on your annual allowance planning. Richard, I do see you've asked the question, can non-taxpayers make use of unused previous annual allowances? Unfortunately not. The reason being is that that is up to your earned income, which is your relevant earnings. As we can see on screen here, those relevant earnings, various income streams that are liable for annual contributions, such as employment income, benefits in kind, income from trade, etc. So Richard, unfortunately not at this stage. Last thing to discuss here is just dividend income. Unfortunately, that also doesn't count as relevant UK earnings. So when we're looking at your tax year end planning, these would be very important things to take note of for sure. Great. Allowances available to you for annual gifting. So this comes down to inheritance tax planning. I've got an example that I'll be able to share shortly. It's £3,000 each tax year. You are able to carry any unused annual exemption forward from the previous year, but it can only be done once. So yeah, there are further allowances for small gifts and wedding gifts. And obviously the key thing here, which you'll see in the following slide, is that you are going to be receiving 40% savings on inheritance tax, which we've got a short little example here. Mr. and Mrs. Brown would like to discuss IHT planning. They have made no previous gifts. You discussed the IHT annual exemption with them. How much IHT could be saved immediately by using the exemption? So this example, it essentially just shows the exact saving that we would be able to make immediately by gifting it out to a loved one, for instance. What you do is that you'd have £3,000 each for Mr. and Mrs. Brown. They haven't made any gifts before, so we can bring £3,000 from the previous year or unused gifting exemption. So it means £12,000 can be gifted out. That would mean 40% of £12,000 is £4,800. So that would be saved immediately, because if you were to pass and your estate exceeds the nil rate bands that you have available, that will be taxed at 40%. So the value of gifting regularly and taking it outside of your estate would be very, very key. Just went back here just to talk about just obviously annual gifting as a strategy. So there is a little example here. So if you are looking to perhaps gift a sum of money to a grandson or granddaughter to help him or her with a deposit for a house, you'd be able to make that gift, and I'm sure the grandson or daughter will be very happy for the help. But that gift, if you were to unfortunately pass within the period of the next 7 years, will need to be drawn back or pulled back into your estate for inheritance tax. So your grandson or granddaughter will actually have an inheritance tax bill to settle. Whereas if we look at annual gifting as a strategy, you might also want to obviously make provision for a deposit for your grandchild. An annual gifting strategy of, say, for instance, £3,000, for instance, that if you consistently do that, takes it away outside of your estate immediately, and that means that you won't have this issue or this potential issue that might befall onto you when you unfortunately have your untimely passing, as those funds are going to be completely outside of your estate immediately when you do that. Great. Okay, the last allowance that we're just going to mention today is the capital gains tax-free allowance. It's set at £12,300, frozen until 2026. The key thing to note here is that there aren't, this was a potential hot topic coming up into the budget, and it has remained at £12,300 because in the sort of manifesto they mentioned that they aren't going to be raising taxes directly, but what they have done is that they've actually frozen quite a few of these allowances, which sort of inadvertently actually increases the tax intake. So that is a key thing. What we've also seen here is that the 23rd of March, the government will be submitting proposals to people in the industry to see what they can obviously put in place for the autumn budget later this year in September. And so this might be something that is taken away. There is talk of it potentially being withdrawn or amended slightly. So as ever, if you do not use this capital gains tax-free allowance, you will lose it. And how this obviously works is that if you make a £5,000 gain on a share, for instance, you'll be able to that £5,000 will be within your allowance of 12,300. which means that you won't need to pay any capital gains tax on that gain that you have realized from that sale of a share. You can claim losses from previous years and set them against your gains. So in my very very simple example, if I made £5,000 loss last tax year, I'd be able to set that against the gains that I make in this tax year, for instance. Great. Okay, last little section here is just to present the tax. There are tax incentivized investment schemes, as on screen. The VCTs, venture capital trusts, EIS, SEIS. Excuse me. The key difference here is that EIS investments are designed to help small companies raise finance by offering a range of tax reliefs to investors who purchase new shares in the companies, while the VCT schemes spread the investment risk over a number of companies. So, I mean, the reliefs for a VCT versus an EIS are the same. There are sort of T's and C's that are sort of key differences between the two. For instance, EIS, you are able to defer capital gains when you do make an EIS investment, an SEIS investment, whereas VCT, you aren't able to do that. But any dividends that a VCT pays you are received income tax-free. So there are some T's and C's attached to these investments. And as you can see, the income tax relief that you are afforded by making these investments will be quite lucrative. But you are sort of held to those time periods that you'll be able to invest. Otherwise, those reliefs will need to be paid back. Okay. Guys, this was a very, very brief, short sort of foray into the tax year end. So as ever, and I've said it a few times, the urgency is there. The 5th of April is fast approaching. And as mentioned, that there is some urgency here. So if you do have any allowances still available to you, then we would implore you to double check that and to approach your financial advisor. You've got my contact details on screen there if you'd like to get in contact with myself to discuss those allowances. But if you guys have any questions at the moment, the floor is yours and we'll be able to discuss them. David, what type of documentation is required for regular gifting? Just notes need to be taken that gifting has been gifted out. So if there are any concerns or not concerns, if there are any worries that they haven't been properly documented, then I would implore you to get in contact with us. But you just need to make notes of the gifts that you do make as you do make them. Any other questions, guys? Okay, so I've got a question here. So once you have taken your 25% tax-free from your pension pot, so long you keep investing, it's still out of your estate. So once you take your tax-free cash, the 25% will form part of your estate. It is received tax-free, but it will be withdrawn into your estate. So if you have access to your tax-free cash, you are taking it away from that tax privileged environment. But I mean, if you are potentially paying off a mortgage or buying a second home potentially, then obviously you would need that lump sum to make use of that. The remaining 75% will still be outside of your estate. So that will still be available to be invested in that tax privileged environment. The funds that you do draw from that will be at your marginal tax rate. And then that's where the importance of the personal allowance, for instance, will come into play. Will come into play there. Hopefully that answered that question. Okay. Any further questions from anyone? As I said, my contact details are up on screen. So if there are questions that might be a bit too personal or sort of have too close of confidential information, then please send them on to me, and we can set up a meeting and we'll be able to discuss it. But if there are any further questions, please make use of my contact details. If not, then we'll wrap this up. Hopefully everybody has a great day further. And as I said, we look forward to chatting with you soon.